Today, we're evaluating two popular ETFs against one another, DGRO and SCHD. Each fund has its own unique strategy and strengths, but which one will come out on top for an investor ready to commit $50,000? We will look at their past and current performance, as well as their return strategies, and then show you a side-by-side comparison of their long-term investment returns over 30 years. When you invest $50,000, one of them offers stability while the other offers growth. Let's find out which ETF has the edge to potentially turn your investment into a much larger fortune. As we unpack the offerings of DGRO and SCHD, let's explore the specifics of each ETF to better understand their positioning in the financial market. This will help you with determining which fund might be the right fit for your $50,000 investment. Starting with the iShares Core Dividend Growth ETF, commonly known as DGRO, this fund is designed for investors who aimed for a growing income. DGRO's strategy is centered around U.S. equities that are not only capable of paying dividends, but are also likely to increase them over time. The ETF selects companies that have a record of raising their dividends for at least 5 consecutive years. This forward-looking approach is attractive if you're betting on growth, anticipating that these companies will expand and, as a result, boost their dividend payouts. DGRO's appeal lies in its potential for compounding growth, making it a solid choice for long-term investors. The sectors it typically invests in, such as technology and consumer goods, are ripe for growth but don't always offer the highest immediate yields. Instead, they provide potential for significant appreciation and increasing dividends, which can lead to greater overall returns down the line. Contrastingly, the Schwab U.S. Dividend Equity ETF, or SCHD, targets a different investor sentiment. Launched in 2011, SCHD caters to those who prefer stability and consistent returns. It tracks high-yield U.S. stocks that are not just paying dividends, but are financially healthy and have a long history of consistent dividend payments. SCHD's strategy involves selecting stocks that meet strict criteria for yield, durability, and a minimum 10-year history of dividend payments. The ETF focuses heavily on sectors like consumer staples and industrials. These sectors are known for their resilience and regular dividend payouts, which are attractive during economic downturns and market volatility. SCHD's approach is designed to provide investors with a reliable income stream, coupled with the potential for moderate capital appreciation. Both ETFs offer a strategic approach to dividend investing, but they cater to distinctly different investor needs and expectations. DGRO might be a better option if you're looking for dynamic growth and are comfortable with the risks associated with younger, faster-growing companies. On the other hand, if your priority is to safeguard your investment while earning steady dividends, SCHD might be the safer bet. Thus, your choice between DGRO and SCHD should align with your financial goals, risk tolerance, and investment timeline. Understanding these aspects of each ETF can help you make a more informed decision, ensuring that your investment not only grows, but does so in a way that matches your financial vision and needs. When evaluating the performance of DGRO and SCHD, incorporating concrete numbers helps in understanding which ETF could potentially turn a $50,000 investment into a more significant sum. Let's analyze their historical performance, current effectiveness, and strategic returns through the lens of quantitative data to see which ETF might give investors the upper hand. DGRO, iShares Core Dividend Growth ETF, has carved out its niche by focusing on companies expected to increase their dividends. This approach tends to shine in economic upturns when earnings growth fuels dividend increases. Over the past 5 years, DGRO has demonstrated an average annual return of approximately 9.3%. This performance reflects the growth-oriented nature of its portfolio, which aims to capitalize on companies with rising dividends, a sign of increasing financial strength and market confidence. During economic expansions, DGRO's constituents typically see earnings growth, which directly translates to stock price appreciation and higher dividends. For example, in the bullish market phase from 2016 to 2019, DGRO achieved an annualized return of nearly 12%. outpacing many of its peers by focusing on dividend growth rather than just high current yields. Conversely, during market corrections and downturns, DGRO's strategy is tested. The fund's focus on dividend growth means that it selects companies that have consistently increased dividends, which typically signals financial stability. This strategy paid off during the market volatility in early 2020, when DGRO's performance dipped less severely than broader market indices, demonstrating resilience due to its focus on financially sound companies. SCHD, or Schwab U.S. Dividend Equity ETF, on the other hand, has built its reputation on reliability and high current dividend yields. SCHD's strategy involves selecting stocks that not only yield high dividends, but also have maintained or increased these dividends for at least 10 consecutive years. Historically, SCHD has shown an average annual return of around 10.5% over the past 5 years, with dividends accounting for a significant part of total returns. SCHD's portfolio stability is particularly evident in its performance during market downturns. For example, during that 2020 market turbulence, SCHD's decline was approximately 20% less than that of major indices like the S&P 500, owing to its defensive positioning in sectors like consumer staples and industrials. These sectors are less susceptible to economic downturns, helping SCHD maintain steadier returns and preserve capital. The current performance metrics further emphasize the contrast between these two ETFs. For example, in the last year, DGRO's returns have been influenced by the broader economic recovery, showing a sharp uptick as markets rebounded. Meanwhile, SCHD has provided a steady return, enhanced by its focus on high dividend yielding, financially stable companies, which are less volatile in uncertain markets. In a nutshell, when comparing DGRO and SCHD head-to-head, the choice between them should be guided by the investor's risk tolerance and market outlook. If you anticipate continued economic growth and are comfortable with some volatility, DGRO's potential for higher growth and increasing dividends could be more lucrative. However, if you prefer a more predictable, steady income stream and greater stability during economic uncertainties, SCHD's conservative, high-yield approach might be more suitable. By aligning your investment with your financial goals and market predictions, you can choose the ETF that best fits your strategy for turning $50,000 into a much larger portfolio. When investing a significant amount like $50,000, a detailed risk and return analysis of DGRO and SCHD can provide significant insight into which ETF might better meet your financial goals. Both ETFs offer distinct risk profiles and return potentials based on their respective strategies and sector exposures. So let's delve into the numbers to see how they stack up. DGRO, or iShares Core Dividend Growth ETF, primarily focuses on companies with potential for dividend growth, which inherently involves a certain level of risk. This risk is due to DGRO's investment in sectors like technology and consumer discretionary, which can be more volatile and sensitive to economic changes. However, this risk is often balanced by the potential for higher returns. As mentioned earlier, historically, DGRO has shown an annualized return of about 9% over the past 5 years. During periods of strong market growth, such as the extended bull market from 2017 to early 2020, DGRO's returns have peaked at approximately 12%, reflecting the growth potential of its constituent companies. SCHD, or Schwab U.S. Dividend Equity ETF, on the other hand, opts for a more consecutive approach, focusing on high dividend yielding stocks in stable sectors like consumer staples and industrials. This strategy tends to offer lower risk, but also slightly lower returns in booming market conditions. SCHD's historical annualized return stands at around 8.5% over the past 5 years. However, its drawdown during market corrections is generally less severe compared to broader market indices. For example, during the market downturn of early 2020, SCHD's value decreased by less than 18%, compared to more than 30% for more aggressive ETFs and indices. The contrast in volatility between DGRO and SCHD is also noteworthy, with SCHD typically exhibiting lower volatility with a standard deviation of returns around 12%, while DGRO can range higher, around 15%. This difference is significant for risk-averse investors who might prefer the more stable and predictable income stream that SCHD offers, even if it means potentially missing out on higher gains during market highs. If higher potential returns justify greater risk for you, DGRO's growth-focused strategy might be more suitable. Conversely, if you seek to minimize risk and value consistent dividend income, SCHD's conservative approach could be a better option. With a clearer understanding of the risks and returns associated with both DGRO and SCHD, let's project the potential long-term growth of a $50,000 investment in each ETF. This side-by-side comparison will consider factors like dividend yield, dividend growth rate, and capital appreciation, helping us to determine which ETF might offer higher returns over the next 30 years. Starting with DGRO, this ETF is structured to favor dividend growth, a critical aspect in the compounding of returns over an extended period. If we assume DGRO has a starting dividend yield of 2.2% and an average annual dividend growth of 7%, along with the annual capital appreciation of 7%, the projections are quite promising. In the first year, a $50,000 investment would generate about $1,100 in dividends. When these dividends are reinvested, they enhance the capital base, allowing for accelerated growth in subsequent years. Over 30 years, assuming continuous reinvestment and compounded growth, the initial investment in DGRO could grow substantially, potentially reaching upwards of $380,000 in capital alone, with total returns enhanced significantly by increasing dividend payouts. In contrast, SCHD offers a higher initial dividend yield of 3.5%, but with a more modest dividend growth rate of 5%. When paired with a capital appreciation rate of 7%, similar to DGRO, SCHD's approach provides a robust blend of stable income and growth. With its higher initial yield, the first year of a $50,000 investment would generate approximately $1,750 in dividends. These dividends, when reinvested, contribute to a more substantial compound effect. Over the span of 30 years, the compounded impact of both capital appreciation and reinvested dividends would likely propel the overall portfolio value above $400,000, making SCHD an appealing option for those who prioritize immediate, higher yields alongside long-term growth. When comparing these two strategies, the analysis suggests that while DGRO offers significant potential due to its focus on increasing dividends, the advantages of SCHD's higher initial yield and consistent growth could potentially lead to a slightly higher overall return after 3 decades. This difference illustrates how the higher initial yield of SCHD effectively compounds over time, particularly when dividends are consistently reinvested, potentially outpacing the slower dividend growth rate compared to DGRO. Both DGRO and SCHD offer unique advantages, depending on your investment goals. If you're leaning towards growth and can handle a bit more risk, DGRO's focus on dividend growth could be more beneficial. However, if you prefer a steady income and possibly lower volatility, SCHD might be the better choice. So, which ETF do you think is better suited for your $50,000 investment? Would you go for growth or stability? Share your thoughts in the comments below, and don't forget to like and subscribe for more insightful investment analysis. Let's keep making smart moves to grow our money.